Hello and welcome to today's Tax in 10 topic on the UK Patent Box, where I introduce you to the topic and give you a few pointers. My name is Margaret Savory and I'm a director at James Cooper Creston, specialising in corporation tax for innovative and technology companies, including R&D tax relief, which is covered in a separate Tax in 10 and Patent Box. Please note that the information is a headline only and if necessary always seek specialist advice specific to your circumstances. Electing into the UK Patent Box gives a reduced rate of corporation tax, 10%, for profits derived from patents. This is compared with the current rate of corporation tax of 19%, which will be applied to sale of non-patented items. Patent Box is a complementary relief to R&D tax credits, the idea being that you benefit from the R&D tax relief as you develop your IP, and then you benefit from Patent Box when you profitably exploit it. To elect into the Patent Box, there are various conditions to satisfy. Qualifying company. You must be a qualifying company, that is, a corporate entity paying UK corporation tax with qualifying IP. The company must actively elect into the Patent Box. This is a one-off election that is made by the company, i.e. it is not per patent, and once the election is made, the company remains in the Patent Box automatically each year. This is an important point, as you cannot cherry-pick which years you would like to be in the box. Once elected, you are in the box. You have to undertake the Patent Box calculations every year, for better or worse. If the company comes out of the Patent Box regime, it cannot re-elect in for another 5 years. The deadline for election is 2 years after the accounting period end, so that can give companies time to see how things pan out before making the initial election. Generally, if your company is making taxable losses prior to any R&D tax relief, it is probably better to delay entering into the Patent Box until the losses have been used up. Qualifying IP. The company must own or license in patents that are with the UK or the European Patent Office, or in the patent offices of a list of 13 EU individual states. The patents can be new patents that the company has applied for, patents that the company has acquired and then further develops, or it can be equivalent rights similar to patents in specialist sectors where they don't use patents, for example, plant breeders' rights. The important date for a new patent is the priority date of application, and sales of a product, including patent pending items, can be included in the Patent Box calculation from this date, provided, of course, that the company has elected into the Patent Box for the relevant accounting period. However, the company will not get the Patent Box benefit until the patent is granted, which may be several years away. The maximum look-back time is 6 years, however. Other ownership conditions include that the company must have undertaken the R&D to develop that patent or undertaken R&D on products incorporating the patent. And as we shall see later, there is an important link between the R&D undertaken and the patent itself. The calculation. The basic premise of the Patent Box calculation is to include all profits derived from patents, and then strip out various aspects of profit which don't relate to the IP. It used to be, and in some circumstances still is, just a 3-step calculation. But any company entering into the Patent Box or creating new IP or IP containing products after the 1st of July 2016 will have to add in an additional 4th step. The 4th step involves linking the R&D work that the company has undertaken and linking it to the patents or patented products that it creates. For the purposes of this tax in 10, we will assume the 4th step applies, but it is something to check with your advisors. Taking the steps in turn. Step 1. For each patented product or suite of products that you produce, you will need to work out a mini profit and loss account for that income stream derived from the patent or patented products. You would take the income from the patented product sales and match this up with the relevant costs, either those that are directly attributable to the income, or on a portion basis, typically that of a just and reasonable basis. As long as somewhere in the product there is a patented item, worldwide sales from the entire product may be included. Take a car as an example. Even if only the patented item is the windscreen wiper, the worldwide sales of the entire car into the company can be included in the patent box calculation. The company may also include income from licenses if it licenses out its patented technology for others to exploit. A company may also benefit if it owns patents but doesn't sell patented products. For example, it has a patented machine that it uses to manufacture its widgets, or it uses patented technology to provide a service. In these circumstances, a notional royalty may be calculated. Step 2. Remove the routine return. This step removes an element of profit from the patent box that arguably the company would make anyway. The calculation is trying to get at the super profit resulting from the patented innovation. This step is termed the routine return. HMRC have prescribed that for administration costs, whatever you sell, you would achieve a 10% markup on those routine costs. And they ask that in this step, the 10% markup is stripped out of your patent box calculation. Step 3, marketing asset return. In a similar vein, Step 3 reduces the patent box profits by a further amount for the brand that the product has. E.g., arguably a proportion of the profits of an Apple iPhone are because it's an Apple, its Apple brand, and not because of the underlying patented technology. Removing the brand element takes a transfer pricing approach. Although there are safe harbors and simplifications for SME, and it can in many circumstances reduce the marketing asset return deduction to nil. Finally, step 4 is the application of the R&D fraction. This looks at how much in-house R&D the company has undertaken on patents relative to what it has subcontracted to fellow group companies. So if you don't subcontract to other group companies, for example, because you're not in a group, this step is not going to affect you in most situations. However, you will need to gather the data to support this. And step 4 applies to the result of the earlier steps 1 to 3. Now taking a detailed look at the R&D fraction. The R&D fraction is given as the lower of 1 and the fraction of costs of in-house R&D on developing the patent or costs subcontracted to third parties developing the patent. This is divided by all of those costs plus the costs of any acquired IP plus the costs of any creation of IP subcontracted to connected parties. This additional step was introduced to prevent companies, typically in a group situation, subcontracting their R&D out to other companies in the group, probably overseas but not necessarily, so that the work developing the patent was not undertaken by the company owning the patent. There are some key points to note. If your company is not in a group and hasn't acquired any IP, you'll know your fraction is probably going to be 1, and in most standalone cases, it probably always will be, although watch if you acquire IP from elsewhere. A key point to note is that the fraction is cumulative for 20 years, so you build on the data each year, so an acquisition can affect you for several years. And you will also need to consider the impact of any patent box calculations of any acquired IP. In all cases, you will need to collect data to support the fraction. So in summary, patent box can deliver tax benefits. However, careful thought may be required. Qualifying conditions and calculations are a multi-step process which require consideration of the interaction between the R&D a company undertakes as well as the IP in the form of patents that it creates. That concludes this tax in 10 on the patent box. If you would like to know more or you wish to seek our specialist advice, then please contact me directly or visit our website at www.eligibility.co.uk. www.jamescoopercreston.co.uk. Thank you for listening.